Hello and welcome to the Financial Empowerment Network Virtual Learning Series. The Financial Empowerment Network envisions communities where low and moderate income individuals and families can achieve financial well-being. Our mission is to advance financial empowerment through partnerships that support access to affordable, effective, and relevant services, products, and other resources. Our process is to serve as a liaison and broker to create connections, disseminate evidence-based and promising practices, and bring resources to a network of providers to integrate financial empowerment into other services, including anti-poverty strategies. Our webinar today is reminiscent of past research and resources we offered to integrate financial empowerment and why Financial Empowerment Network believes collaboration is crucial to moving individuals and families on a forward-moving financial trajectory. As shown in the slide, our Your Money Helpline resource guide was modeled after the guide used during 2008 New York City Phone-a-thon to assist volunteers who fielded calls ringing from consumers situated in the 5 New York City bureaus. As noted on the cover, the Financial Empowerment Network in 2010 was known as the Seattle-King County Asset Building Collaborative. The name changed to the Financial Empowerment Network in 2014. As we all try to navigate these uncertain times, the Financial Empowerment Network would like to share another resource to assist in mitigating the financial impact of the expanding outbreak of COVID-19 on family units and their ability to meet financial obligations. A small dollar loan is a benefit employers could offer to assist families experiencing a reduction in their household cash flow. I'm Alice Cody, and I've been with the Financial Empowerment Network since its inception in 2006. First as a volunteer representative during my tenure with a partner organization, and then as staff. One of my first assignments with the Seattle-King County Asset Building Collaborative was to research small dollar loans. In 2009, the FDIC piloted a small dollar loan study and referred me to Doug Ferry. At that time, Doug was with a small San Diego consulting firm whose focus was on innovative solutions to difficult socioeconomic problems. Previously employed at Intuit, he gained insight in credit issues and alternatives to payday lending in the management of TurboTax consumer business. In 2008, the consulting group obtained a patent for the employee loan benefit program, now Trueconnect. In the research and development phase of their employee loan benefit program, they found that significant bank fixed costs were primarily the same regardless of the loan amount. They borrowed from the proven 401k loan models and the system integration of design of tax software. Their goal was to achieve a method to strip out the buckets of fixed lending costs so the savings could be passed on to consumers through small dollar loans at lower interest rates. As explained to me during my 2009 interview with Doug, you essentially are repackaging small loans as a benefit program and leverage software integration tools to reduce costs dramatically. It is my pleasure to introduce you to Doug Ferry, co-founder of Trueconnect, and again, welcome everyone.
Well, first of all, thank you, Alice, for that great introduction, and you're bringing me way back down memory lane to when we first started working together. As Alice mentioned, I'm one of the co-founders of a company called Employee Loan Solutions, and we're talking today about our program called Trueconnect. I was one of the participants in the FDIC small dollar loan pilot program way back in the day. We had an idea that came out of some of the work that we had done when we were working together at TurboTax, and were spent a lot of time, probably about a year and a half, talking to and interviewing and meeting with people who were relying on payday loans, car title loans, pawn shop loans, and similar kinds of credit issues based on the fact that they did not have credit scores or had really damaged credit and had a hard time talking and working with banks, traditional banks and credit unions. And as Alice mentioned, when we were talking to traditional banks and credit unions, we would try and figure out, why are you not offering an alternative, especially when the consumer is spending 300, 400% interest for these small dollar loans? You're a bank, you're a credit union, you should be able to do better than that. And yet they conveyed over and over again that it was very, very difficult for them to do so, that these were small dollar, high risk loans. And they didn't have systems in place or infrastructure in place to really make it scalable and affordable. And so we decided that we were going to try and do what we could to address the need, and the result was Trueconnect. So I'm thrilled with the opportunity to share a conversation with one of our customers, the city of Phoenix, Arizona. We actually have a lot of employers, over 1,000 employers across the United States, that have Trueconnect available as part of their employee benefit package, both private and public sector, ranging from very large private sector businesses like Comcast, NBC, Universal, with 160,000 employees across the United States, to city, county governments, school districts, community colleges, and even not-for-profits, as you'll see with the Valley of the Sun United Way and a few other local United Ways, Boys and Girls Clubs, Catholic Charities, and similar organizations around the country. So appreciate the opportunity to answer any questions you all have at the end after seeing this presentation, and many thanks to you, Alice, for putting this all together. I'm thrilled to introduce Lori Bays, Chief Human Resources Officer at the City of Phoenix. Lori, you obviously played the decisive role in terms of working with the Valley of the Sun United Way to address financial health and financial wellness issues in your workforce, as well as making the decision to add Trueconnect to your employee benefit package. So thank you very much for your participation on this webinar.
Of course, happy to be here.
So obviously, as the Chief Human Resources Officer, you have a responsibility to recruit and retain a workforce of 14,000 plus employees in the city. So what are your priorities in that role when trying to recruit and retain an effective workforce? And where does financial health fit into that broader picture?
Yeah, that's such a great question. We have over 400 different program areas across about 36 departments, depending on how you count them, in the city of Phoenix. And we obviously, because of that, have to recruit and retain a wide variety of people with different skill sets, with different educational backgrounds. And we strive to do one thing with our employees, which is to really look at them holistically, look at them as whole people who bring with them families, outside interests, individual perspectives, wonderful cultural dynamics. We really want to view our employees as the valuable assets that they are to the city of Phoenix, not just to us as a government organization, but to our community. And we know that people come to public sector work for three primary reasons. They want to make a difference, they want the job stability, and they want great benefits. And we really strive to support all of those things, and that well-rounded view of our employees. And we want to offer them opportunities to be healthy physically, mentally, and financially. We really believe that that's an important aspect of supporting our employees. So it's not just through base salary, but it's through offering them opportunities to be financially stable. Because that's something that no matter if they work for us for 30 years or for 3 years, they can take that with them and that those lessons that they learned. So we really think that that's important to offer those opportunities, which includes education, but also, programs like Trueconnect to help them manage their finances.
So let's talk a little bit about the numbers. Obviously, we know some of the details about the workforce of the city of Arizona, but some of the attendees may not have a picture of how broad and diverse and numerous the number of employees are. Can you touch on some of these data points?
Sure, yeah. So we've got a total of about 14,000 employees. It looks like we're missing a data point on that slide, but I'll fill that in. We've got about 12,500 of those 14,000 are full-time employees. So the vast majority of our employees are full-time. The remainder are part-time and seasonal. We do have a pretty decent median salary of about $64,000. But we also have almost a quarter of our workforce that earns at or below $48,000. And a percentage, about 8%, is up toward that $100,000 mark, around $97,000. So we've got a wide range of earners across our employee population, as you might imagine. One of the things that we really try and do is look at our employee demographics and make sure that we're meeting needs as it relates to employee benefits based on all of the different individuals that we have in our employee community. And we want to make sure that we're offering options that are going to be attractive and will meet the needs of the employees that we do have. And we work very closely with our employee labor representatives to ensure that happens.
And Laura, you mentioned that robust employee benefits are one of the driving factors that cause people to want to work for the city as opposed to other choices that they might have. So when looking at the wide array of different benefit offerings that the city provides to its employees, what caused you to look at financial wellness and financial health as something that should be added to that mix? Obviously, you were working with the Valley of the Sun United Way before you were working with Trueconnect. So what were some of the criteria that you were thinking about once you made that decision to figure out what would be the right tools to make available to your employees?
Yeah, we have realized for quite a while that there are financial wellness needs amongst our employee population, and we've provided different programming, financial wellness classes and things like that. We've also had one of our indicators that we knew we had a need was we have a deferred compensation program that has a loan program associated with it. And we've seen consistent usage of that program over the years. And most of the usage is for some sort of financial hardship, avoiding eviction and, really trying to make sure that those basic needs are met. And so we wanted to continue to find ways to address that need. And we were concerned that the one, kind of true program that we had, the loan program, was something that actually took away from employees' retirement planning, because we didn't want, someone to have to make the choice to, jeopardize their future financial stability for their current state. And so we wanted to be able to offer something that was a little bit more immediate and didn't take away from that retirement planning. So that's really what kind of piqued our interest when we started talking with Valley of the Sun United Way about, things that are out there as far as options, and learned a little bit more about Trueconnect. We also, we were not naive to the fact that we knew our employees were, unfortunately, having to participate in some of those more predatory practices as well. Some of them didn't have those DCP accounts that were, robust enough to pull from. They were newer employees, lower income earners, and didn't have as much in those accounts to begin with, so they were going to the title loans and other predatory practices, and we wanted to find ways to help people to get out of that. We were already aware, based on the work that we've done through Human Services with Valley of the Sun United Way, that over 40% of Americans can't afford a $400 emergency expense, and our employees were no exception to that. So we wanted to make sure that we had those options available so that our employees, know that we value them and we care about them and we want them to be well, both physically, mentally, as well as financially. And we wanted to find a program that would have something that our employees could feel comfortable with. As I mentioned, we have labor representatives that we work with closely, and they are not shy about telling us, what employees will like and will not like. And one of the things that they were concerned about is, this has to be a program that employees feel safe using. It needs to be something that's private, confidential. It needs to be something that doesn't have an exorbitant interest rate. That can be left up to interpretation. But, if you're looking at a title loan, which has, ridiculous interest rates versus a much more reasonable, comparable to a credit card interest rate, that was something that they thought was palatable. Something that was easy and quick for employees to access. No credit check was really important. And then also, having a maximum amount, because we didn't want to provide something that was going to cause our employees more problems than it solved. And, something that really didn't allow them to get in over their head. So those were kind of our main things that we looked for, as well as that payroll deduction, which makes it really easy and simple to pay back.
That's fantastic analysis. So obviously you have a wide range of different kinds of employees working for the city. As you mentioned, some of those employees probably have good or excellent credit scores and have options available when financial situations come up. Whether it's going to their local bank or credit union, or paying for it on a credit card that they can afford to pay off later. They might own a home and can take out a home equity loan if the size is big enough. It sounds like you had a gap for those employees who didn't fit in that category, or did not have a retirement plan or a 457 deferred comp plan to borrow from, or who wanted a better option, like you said, than borrowing against their future financial health to address their current financial health needs.
That's correct. And the other group that we have in the city of Phoenix is that entry-level worker who is just starting out, perhaps not earning a lot, and hasn't even had a chance to establish a credit history, but might run into an emergency expense. So we wanted to make sure we were addressing needs of that group as well.
Do you think that need is going to be bigger or smaller, or the same in the context of the pandemic as people are dealing with that?
Well, obviously it's too early to see what the data is going to show us, but my gut tells me there's going to be an increased need. We know already that we've seen a increase in our deferred compensation loans. We've seen a slight uptick in our Trueconnect loans, but we believe that we would have seen a decrease in our deferred compensation loans had the pandemic not hit. We're just really feeling like employees are using all the resources available to them, and that's telling us that even with adding additional programming, there's still a very high need, and a lot of that, I can't really see how it's not related to the pandemic. There's just been so much uncertainty in employees' personal financial situations. We've been very fortunate that we haven't had to lay off or reduce any of our employees, but we know that many households that our employees live in are multiple income households, and we have we know for a fact that our employees have been impacted, even though it's not a direct impact through the city. And so that need is certainly there.
Well, thank you, Lori, very much. Let me quickly talk a little bit about the Trueconnect program that both you and Scott have available for employees of the City of Phoenix and for employees of the Valley of the Sun United Way. Obviously, I'm hopeful that everybody on this webinar already knows a lot about our program, but they may not. So I want to touch on some of the specifics. First and foremost, there's no cost or financial liability to either employer or to any employer that signs up. The employer is not funding the loans. They're not guaranteeing the loans. They're not subsidizing the loans. It's just an additional benefit option available to their employees should they need it. As both of you mentioned, an important feature of the program is that we do not use a credit check of the employee when they're applying for a loan. So an employee who has a credit score that's above average or excellent probably doesn't have the same needs as somebody who already knows that they have no credit score or their credit score is bad. And as we talked about before, those are the most economically vulnerable and the ones that are most likely to turn to solutions like payday loans and car title loans that have huge financial impacts. The loan decision is automated online. It's issued by an FDIC insured bank. So we at Trueconnect are not a lender. We're simply connecting the employee to a federal bank that is making the loan. And that loan is based on the employee's income and length of employment at their job. So we're not looking at a credit score. We're not pulling a credit report. We're simply assessing their ability to repay the loan based on their status in the job. Every employee is offered the same rate. The loans are shown as a one-year repayment term at 19.99% APR. If you're taking out a car loan or a home loan where you've got a much longer repayment period for a much bigger period of time, obviously you can get a lower interest rate if you have good credit or excellent credit. But keep in mind, these are unsecured loans from a bank with a one-year repayment term. So that translates to about 90 cents per month for each $100 that's borrowed over a one-year term. It's pretty remarkable for the borrowers who are used to paying 400% for payday loans. All of the payroll deductions that are deducted from their paycheck over a one-year period to repay their Trueconnect loan are reported to the three major credit agencies as an on-time in full repayment on a bank loan. So an employee that maybe doesn't have a credit score or has poor credit and is struggling to restore their credit score, they actually have an opportunity to do that just by having the Trueconnect loan payments coming out of their paycheck. We do include for all of our customers up to 6 free credit counseling sessions a year through a not-for-profit federally licensed credit counseling organization. Obviously, there at the City of Phoenix, you have a great partner in the Valley of the Sun United Way with other robust financial coaching programs. So, that's not always available with every employer, but it's great that you have that. And Trueconnect is offered to employers all across the United States. Obviously, you two represent city government and a not-for-profit, but the vast majority of Trueconnect employers are actually private sector businesses. So we range from very large companies like Comcast, NBC, Universal, down to smaller not-for-profits as well. So that's my plug. So I want to turn back to Lori a little bit. Obviously, your city employees play an important role in providing services, to the broader Phoenix community, and is also obviously one of the largest employers in the city of Phoenix. So when you're making steps as the Chief Human Resources Officer to improve the financial health and wellness of your employees, do you see that having a broader community impact in terms of their ability to function on the job and meet the needs of the broader Phoenix community?
Oh, absolutely. We believe that healthy employees, provide the best service to our community. And again, I've said it a few times already, but healthy really means physically, mentally, financially, the well-rounded view of healthy. And it's important for all of our employees, no matter what role they play, whether they're out on the front lines, as a solid waste equipment operator, that's our fancy way of saying garbage truck driver, or a police officer, firefighter, or a human services caseworker, or whether they're behind the scenes and they're an accountant or a contract manager. They contribute to the quality of life in our community, and the more focused and healthy they can be at work and able to focus on their job and what they're doing to assist the community, the better. If they have to be worried about bills at home and how are they going to pay their rent or buy diapers for their child, that's going to take away from their ability to focus. And we really want our employees to feel secure so that they can focus on their jobs while they're here and while we're assisting our community.
As you mentioned, Lori, you all made the decision to launch Trueconnect as part of your employee benefit package. I think it was in January of 2019. Can you talk a little bit about sort of what that launch looked like and what the kind of initial participation rate looked like among your employees?
Sure, yeah. Let me talk about the response first. When we first started sharing with people that we were going to be launching this program, we got a really interesting response. Some people said, wow, do we need that? And then, I would be able to explain to them why we needed it. And other employees, said, oh, wow, that's great. That's really needed. And they got it immediately. We did have a mixed reaction to the program, some of the program specifics. At the time when we launched it, the interest rate was 24.99%, and it has since dropped, as you mentioned, to 19.99%. And so we got some mixed reviews on that. Some people thought, oh, wow, that's great. That's much better than the alternatives, and they really understood it. And some people said, oh, wow, that's kind of high, but only looking at it from the perspective of someone who's able to get a better interest rate, as you mentioned, from a bank or a credit union or something like that. So when people understood the broad needs in our employee population, they really understood the value of the program. And when we launched it to employees in January of 2019, we immediately, in the very first month, had 174 new loans issued. And then in the second month, another 207. And we have since had over 1,600 loans issued in the last year and a half or so that we've been working together. So we really see it as a great benefit to our employees. Obviously, there's a need there. Obviously, there's value seen in the program based on the usage. And if you do the math, it's roughly 10% of our employee population. If you back out some of the multiple loans that one employee may have that have actually used this program, and that's great because we want people who have a need to use the resource so that they don't have to go to less beneficial alternatives.
So one of the data points on the slide that I'm showing right now is that the average income of an employee of the city of Phoenix who used Trueconnect was a little over $53,000 a year. That's not like poverty wage, even in Phoenix. So were you surprised at the wide range of income levels of employees who needed a service like Trueconnect as part of their benefit package?
Going into this, we were focused more heavily on some of our lower income earners, and that 20 almost 25% of our population that earns less than $49,000 a year. But I really wasn't surprised when we saw that some of our higher income earners were using the program. Just living in this world, it's easy to understand how much the cost of living has increased. You never know when some sort of unexpected expense is going to come up, and that's going to happen to a little bit higher income earner as well as lower income to lower income earners. And we want to make sure that we don't assume that just because someone earns a higher salary that they have a lot of savings. For example, cost of living is high. People have a lot of demands on them, and we know that income earners at all levels are going to have those emergency needs. And as Scott talked about earlier in the program, at least a minimum of 60% of earners are living paycheck to paycheck. So that means that it's not just the lower income earners. A lot of people are really stretching their dollars to make it from paycheck to paycheck and month to month. And so I really wasn't that surprised, and it just made me glad that we do have this option available.
Well, thank you. We do a survey, or we send a survey to everybody who takes a Trueconnect loan to get feedback from them about the user experience, make sure that we're continuing to meet the need, look for improvements in the product. And one of the questions that we ask them is, before you had Trueconnect as part of your benefit package, what other kinds of credit have you used? And these are the results specifically from the employees of the city of Phoenix. So we had about 212 of the employees who took a loan last year who agreed to complete the survey. And you can see that there's a pretty high percentage of people who say that they had used payday loans or car title loans in the past. I know you mentioned, Lori, that you had kind of a general idea that was already happening in your workforce. What jumps out at you when you see the data from the employees?
Yeah, this data really confirmed what we suspected was happening. We knew the part about the retirement loans being taken out because we've already seen that data, but we suspected that employees were using the payday and title loans as well. And this just confirmed that, and it also, confirmed the need in our employee population for a program like Trueconnect.
We also asked them, what are you using your Trueconnect loan for? We don't do that up front. Obviously, the employee can access the loan for any kind of emergency need. We suspect, we don't know yet, but we suspect that, one unplanned emergency that we're going to probably be seeing over the last 3 or 4 months, and maybe for the next 3 or 4 months, are expenses related to, the COVID pandemic. But these are the results from what city employees said that they used their Trueconnect loan for. Obviously, the biggest use was for home-related expenses. That might be a leaky roof, a broken air conditioner, faulty appliance, car-related expenses, etc. We leave an option available for other, and there's a wide range of other that city employees identified. Can you touch on that a little bit in terms of the wide range of potential unplanned costs that an employee might face?
Yeah, this just really speaks to everything that, our employees are dealing with on a day-to-day basis. And it also speaks to that need to really have something available that can provide that peace of mind. If an air conditioner goes out in Phoenix, Arizona, it's a big concern. It's a health issue, and that needs to be addressed immediately. And as most people on this call, I'm sure, realize, that's not a small investment. And so an employee having to worry about that and figure out a way to pay for that expense, it's really going to be something that allows them that peace of mind and that feeling of security to know that they have something available to them to take care of that, so that they can get that fixed and take care of their family. And it's just, there's just a wide variety of those things. You know, there was a little bit on there for vacation or travel, but other than that, I mean, nothing really on that list jumped out to me as anything frivolous. You know, these are really expenses that are for true needs, and it's important to our employees that we're able to help them meet those needs.
These are some of the kind of open comments that city employees have provided as part of the survey. You know, we can send these out afterwards for people to really look at, but you know, a couple of things that you touched on early, Lori, kind of came back unsolicited from the employees about the importance of the privacy of the transaction, you know, their ability to do it online without having to go to their HR department and talk to one of their coworkers about their financial needs. You know, about 75% of Trueconnect borrowers actually do it from their phones. So it's fast, it's convenient, and obviously the employees are providing that feedback. The automatic payment through payroll deduction is also something that they, you know, stress and point out as a feature and a benefit of the program. As one less thing that they have to stress about. You know, if you're living paycheck to paycheck and you're trying to plan to make sure you have enough, you know, before your next paycheck to cover all your bills, this is just one less thing that they have to worry about. And we certainly see that feedback from your employees, which is pretty consistent with what we see across the board, obviously. So obviously you have a lot of experience in offering financial wellness services, not just Trueconnect, but some of the programs available through the Valley of the Sun United Way. With some of the other employers that may be on this call or on this webinar, as well as some of the benefit brokers who are talking to their clients about this, what would be your advice, whether the employer is private sector or public sector, about how they should think about financial wellness and how they should think about programs that they can make available to their employees to address it?
Yeah, I would definitely recommend that any organization consider having a program like this if they don't already. Some organizations may feel like, oh, you know, our employees don't need this, and I would challenge that and say, you know, no matter what type of organization, there are most likely employees in your organization that do need a program like this and that would benefit from it. And even if only a small percentage of your employees use it, you are sending a message to your entire organization that we value you and we want to make sure that your needs are met and that you have that safety net. The other thing that I would say is, you know, this also helps show having a wellness program, a financial wellness program, helps show your employees that you view them not just as someone who's coming in to produce, you know, a product or a profit. You view them as a whole being who, you know, you want to support in all ways. And this is one aspect of it. I would also encourage, you know, supporting physical health and mental health. But this is important as well. And if people can't have their basic needs met, and financial needs are one of those, then they are not going to be the productive, quality employees that you want them to be. So I'd really encourage any organization to think about a program like this. And ultimately, I mean, with Trueconnect specifically, there's little liability on the organization side. That was one of the things that was very attractive to us as well. You know, we are not on the hook if our employees default. There are things in place to help them not do that, but ultimately that's between the lender and the employee. We are offering a service, and you know, there's really a lot of upside and not a lot of downside.
Okay. thank you all very much for listening through that. I'm going to give an opportunity for our VP of Marketing, Rebecca Smith, to circle back to Alice or to myself with any questions that may have popped up along the way.
Great, thanks so much, Doug. Hi, everyone. This is Rebecca. We do have a couple questions coming in, so let's get right to them. The first one, this one is, I think there's a couple questions in here that we're looking for answers for. So what is the interest rate that we should use to distinguish between payday loans and non-payday loans? For example, in Washington State, the usury law sets a max rate of 12% or 4% above the Federal Reserve rate as allowable and would deem 20% to be usurious. Is there a better way to reduce the interest rates to people with fewer resources by using corporate guarantees or risk sharing for employees?
I'll take that question. So, you know, at the end of the day, it's just math. So if there is an employer that wants to subsidize the rate in order to make it even lower than it already is, you know, we certainly can do that. You know, the reality is that for a program like this, you know, I think the use rate kind of speaks for itself, that it's already a substantially lower rate than what people are using today. So yes, we're open to those conversations, and you know, we're happy to be flexible where it needs to be the case.
Can we circle back to the beginning of that too, on what's the interest rate that we should use to distinguish between payday loans and non-payday loans?
Sure. So payday loans, if you're not familiar with how they work, and I'm not, you know, an expert in Washington state law by any means, and so maybe Alice, you know, can chime in on this as well. But essentially, the payday loan model, you know, the storefront loan model is typically one where you're paying a fee of a certain percentage of the amount that's borrowed, and the entire amount is due back in essentially your next payday. So if you're borrowing $1,000, there's typically a fee of about 20 to 25% of that balance, meaning a total of about $1,200 or $1,250 is due back in 2 weeks. So if you're a borrower and you are needing $1,000 today, the chances that you have $1,250 2 weeks from now is pretty slim, because even though you've gotten paid, you have your other ongoing recurring expenses. That might be your rent, your car payment, your food, clothing, etc. And so according to the Consumer Financial Protection Bureau, Center for Responsible Lending, Pew Research, and a number of other independent sources, the typical payday loan borrower flips that loan an average of 8 or 9 times before that loan ends up getting repaid. So they're paying an additional $200 to $250 fee every 2 weeks trying to pay down that balance. And so you can see that that adds up pretty quickly, you know, to the point where the person is paying substantially more in fees and penalties than the amount that they had originally borrowed. Whereas with a Trueconnect loan, the same employee borrowing $1,000 might have a payroll deduction if they're paid biweekly of like $44.12 or whatever the calculation turns out to be. So they have a small amount of both principal and interest deducted from their paycheck, much more manageable, much easier to pay. And the total amount that they've paid over that time period is substantially smaller as well. So as I said earlier in the presentation, it translates to about 90 cents per month for every $100 borrowed. And the borrower can actually pay it back early at any time with no penalty, no fee. and that would also effectively reduce the interest rate. So if they wanted to pay it back in full, like they would with a payday loan with a 2-week repayment period, that same $1,000 loan would cost the borrower less than $6 in interest compared to $200 to $250 in fees. So I think that kind of describes the difference between a payday loan structure and a kind of traditional consumer installment loan from a bank that is what Trueconnect is offering.
Great, thanks, Doug. This might be a question a little bit more for Lori, so I'm going to rephrase it just a little bit. But getting an HR department to take on an additional payroll deduct slot can be difficult. The ability to leverage HR access can really be a major hurdle. What got you over that hurdle? Can you talk a little bit, Doug, about some of the things that we have in place to make it actually easier for HR and it's not like an extra burden?
Yeah, so I think sometimes there is a belief or a concern that this is going to require a lot of additional work for the Human Resources Department. I think, when we talked to Lori about it, I think her exact phrase is that Trueconnect was by far the easiest, lowest work level onboarding and administration of a benefit program of any that she's offered in her history in human resources, which was really great to hear. So essentially what is required in order to get Trueconnect set up for an employer is a 1-hour kickoff call with our implementation team to kind of explain the end-to-end process, working with their payroll department to make sure that they can receive the payroll deduction instructions authorized by the employee that takes a loan. And we can usually get it set up with an employer, depending on how fast they want to go. We can get it launched in as fast as a couple of weeks. So it's not an extensive, labor-intensive type of process to get it set up and launched for an employer. If an employer wanted to set it up starting tomorrow, we could probably have it ready for their employees to use, by mid-August. And then the program is automated, and so whereas with a 401k program or other employer-based employee loan program, where there's a lot of involvement of the HR department in interviewing the employee and determining whether it's an approved use, they have to explain why they're taking the loan. This is all done online by the employee. As we said, about 75% do it from their phone. And so it's just an automated process. The loan decision is automated online, and the payroll deduction instructions are sent to the employer through an automated process. So it's very low impact, very low administrative activity that's involved.
Great, thank you. Another question that just came in: if employees default and credit is reported to the bureaus, how does that affect their credit scores?
Sure. So obviously, as long as the employee is employed and has the payroll deductions coming out of their paycheck, we're able to report those positive payments to the credit agencies, as an on-time in full payment on a loan. If they do leave the job, the employer, first and foremost, is not responsible financially for paying that remaining balance. The employee is notified by us that they have a balance, let's say $362.11, and we give them a lot of different options for how to make those payments outside of payroll deduction. They can pay directly online through their account at our website. They can make electronic payments, through their bank account, and we walk them through all of those various options. Now, if the employee ultimately decides not to stay current with their loan and defaults on their payments, then obviously we're required by law to report that as a negative event, and just like any other negative event on their credit, it can reduce their credit score. But our overall goal is to try to make sure that people to the greatest degree possible are able to take the loans and pay them back. And for a program like this that is not using a credit report or pulling a credit score as part of the process, we have a default rate that's in the very, very low single digits. So the vast majority of people who take Trueconnect loans are able to pay them back successfully, and that's always our goal.
Wonderful. One more question. What is your cost to provide this program?
Our cost, I think the nature of the question is, what is the cost to the employer? So whoever asked the question, if that's not what they intended, if you want to send a clarification, but there is no cost to the employer to make Trueconnect available as part of their benefit package. It's just something they sign up for and make available. And as it was mentioned earlier, the employee does obviously have to pay an interest rate, but they are all shown the same interest rate. So unlike a traditional loan from a bank or a credit union, where the lender is looking at you, the borrower, and evaluating your credit worthiness and adjusting your interest rate based on your likelihood of being able to repay. That's where people who have bad credit or poor credit get into a lot of trouble. They either get turned down, the vast majority of them will get turned down for a bank or a credit union loan, or they're charged a very excessive rate. So if there are state usury limits from a state lender, chances are they're going to be turned down for a loan from a traditional bank or credit union, and they'll end up going to a payday lender, a car title lender, online lender that's going to charge them a triple-digit interest rate. And so Trueconnect is available as an alternative to that at 19.99% APR with no fees. If the questioner had a different intent in mind, I'm happy to re-answer it.
Okay, great. That's the extent of the questions that we have right now. We do have a couple more minutes, so if anybody wants to submit any more questions, please send them in now. Otherwise, Doug, Alice, I will hand it back to you just to close things out.
Okay, thank you. I actually have a question for Doug. So, Doug, for any financial institution or credit union that's on the call, are there opportunities for them to participate? You're currently using Sunrise. Is there opportunities to expand that lending network?
Absolutely. I appreciate your asking the question. So we do have both. I'm going to answer a question you didn't ask. We do have additional financial education and coaching partners in different communities. Like the Valley of the Sun United Way in Arizona, we have other local United Ways and other financial education and coaching groups that we work with for employers and employees within an area. So if there are folks on this call in Washington State that think that this would be an effective tool in your toolbox to help the financial health and wellness in your community, we certainly do partner with organizations like that. And then some of those organizations are also local lenders, local banks or credit unions that either want to promote Trueconnect along with the financial education and coaching services that they offer to a particular employer or group of employers, or in some cases they actually provide the loan funds for employees of a particular set of employers. So for example, in Santa Fe, New Mexico, we have a cluster of employers in the Santa Fe, New Mexico area, including the city of Santa Fe, the Santa Fe Public School District, a couple of community colleges, county governments, and we have a local credit union there that actually co-brands the Trueconnect experience for those employers, provides the loan funds that are used to fund those Trueconnect loans, and they receive the interest payments back. So we have that flexibility to do it. We just don't need the money from a local lender to run the program in Washington State, because we do work with a federal bank. But we're very open and interested in talking to local lenders in Washington State that might want to be a part of it.
So Doug, for those that are interested, how would they contact you?
Yeah, great question.
I'm thrilled to introduce.
There we go. I'm gonna put it up on the screen in the slide deck. My email address is doug@emploan.com, or my telephone number is area code 858-405-9529. Again, that's 858-405-9529, or my email address is doug@emploan.com. Not only if they're interested in working with us or partnering with us, but if anyone has additional questions that they were too shy to ask in the webinar format, I'm very happy to address those. And Alice, I just want to thank you very much for your role in helping introduce us to the folks that are on this call. And obviously Washington State is just as impacted and affected by the COVID pandemic and other financial issues that are going on in our country. And so if there's a way that we can help more in Washington State, I know we already have employees in Washington State of other employers that have Trueconnect as part of their benefit package, but we'd love to make it more widely available.
Great. Thank you so much, Doug. I really appreciate you and Rebecca joining us today. Again, thank you everyone for being part of this webinar. And as always, you're welcome to email me with any questions or concerns. And so thank you and have a wonderful day. Thank you.
Thank you very much.